Hey, good afternoon, everybody. Marty Missouri here. It is Thursday, the 16th of November, 2023. End of week market snapshot. Clients, once again, you'll get it in the morning. This will serve as Friday's morning message. Later on Friday, I'm going to try to get the economic update done and out to you as well. Speaking of economic update, I am actually going to touch on several of the inputs to our own general conditions index. We call it the PWA index. Essentially, I just want to reiterate the case for the bulls. It's pretty easy to decipher what's going on, quite frankly, and we got more support for that trade today. And first one in front of you is U.S. industrial production continues to come in very, very soft. Of course, clearly the manufacturing space has been in recession for multiple months now, and that continues. Home builder sentiment, the so-called housing index for the U.S. came out today. Below 50, folks, means that the sector is in recession. It's essentially from a sentimental view gained from the answers to the questions posed to several hundred builders. And you can see 34 is low, historically speaking. Prospective buyers traffic is uber low, historically speaking. And of course, we know what's going on. We have mortgage rates in the mid sevens, I believe, currently. So still modern history high, I would say. And that's a huge deterrent for folks, either selling home, coming out of a 3% mortgage, or anybody looking to buy a home. Today, sadly, the first-time home buyers pretty much don't have a shot right here just yet. Initial jobless claims ticked up once again. Now, the levels are historically low. I read a couple of commentaries from Bloomberg this morning basically saying that the jobless claims numbers support the notion that we'll be able to dodge recession going forward. And I thought that was interesting. And they're speaking to how low they remain, historically speaking. And I get it. My observation, though, is that while I'll acknowledge the level, I also want to make very clear that the latest trend and the rate of change is exceedingly important, right? Here we were at historically low levels in the early 70s, and we ramped up, looks very much like this chart, and then we were in recession. And then continuing claims continue to go higher as well. So yes, we're going to need to see higher jobless claims before we see recession. Yes, there could be some seasonality in here, but again, it's about the direction, and that is clearly, in my view, a red flag around the economy going forward. Retail sales came out this week. They actually came in close, or maybe even a little better than expected, but nevertheless, the trend continues in the wrong direction. And then last but not least, the NFIB Small Business Survey came out this week, and it is not pretty. Here's the overall optimism score. Hiring plans ticked down a little bit, and then CapEx, business expansion plans were flat. So folks, again, as I said twice on the written blog this morning, this is late cycle phenomena. Data rolling over, market rallying. I've shown you how this has played out right when late in the cycle, the data begin to soften, the stock market begins to rally because this view, this Pavlovian view, that weak data means the Fed is going to ease off, they're going to get soft and so forth. I could argue that right now the market is loosening financial conditions, essentially setting the stage, if indeed we're not going to have recession, for more stubborn inflation going into next year. And even if we got down to the Fed's inflation target and things begin to stabilize, why in the world would they need to cut interest rates in that environment? I read a very thoughtful piece by Bob Elliott this morning, and I thought he was spot on. He essentially made that case, and that is that everybody's assuming that inflation's going to come down and the Fed's going to lower interest rates. But in this soft landing, beautiful, immaculate, perfect scenario, yields are beginning to fall, right? Inflation's beginning to wane, and conditions are beginning to loosen, and asset prices are beginning to rally. There's just nothing there that says the Fed should be loosening policy. It almost suggests that policy is where it is and rates were where they should be. Now, we do think that the Fed will be cutting interest rates next year, but it won't be because they've landed the plane perfectly. It'll be because markets are taking a potentially massive downside hit relative to poor earnings and recessionary conditions, and the market doesn't react to that first 2-3 times, at least historically, because we're in recession, continues to fall. And there's a point, though, when everybody's panicking that we absolutely want to be buying stocks. But this still has so much to play out, as I continue to say. Just look at Walmart and Target this week. Both of them basically gave anything but rosy outlooks about the state of the consumer and what they're seeing in their sales. Walmart was down over 8% today after announcing their earnings in the pre-market. Target yesterday actually had quite the up day. They still had negative commentary generally about the consumer. They just had pretty good profits because of the way they managed inventories and yada yada. So the market loved that and rewarded them for that. It was down a little bit today, nevertheless. But my point is, we want to read through those commentary from those CEOs to get a feel for what the future says, and it comports with everything we're seeing in the data. Again, the market with its chronic myopia only sees weak data, softening Fed, yada yada, and that very well could take us to the end of the year with a nice, year-end rally and get everybody sucked in to what may be a massive bull trap if indeed these recessionary data continue to evolve in the direction that they're evolving. Okay, so anybody not interested in the technical analysis, thank you as always for watching and listening. For the rest of us, just a minute or three. S&P hourly chart doesn't look good right here, folks. Again, I just said, wouldn't surprise me to see a year-end rally or this rally continuing. I mean that, but right now when I look at the very short-term hourly chart, this is essentially no bueno for the bulls. We have very definite extended negative divergences against a rising wedge, and we broke out of that sideways right now, so we'll see how that plays out. However, on the daily, we are not talking a profoundly bearish setup like we are on the hourly. Yes, we are hitting some potentially serious overhead resistance right here. Yes, I think we have a gap to fill right there. I think we ultimately will. It'll be interesting if we don't fall back and test this downtrend line and find support right there. You can see there's a couple lines of support and so on, but not as immediate term bearish looking as the hourly. So I would flip a coin right here and maybe lean toward the bull side just for seasonality and flow, and so everything that goes with that. Definitely will be some down days between now and the end of the year, and maybe this trend will reverse. You could definitely make a case for that, but I can see enough other things that tend to coincide with the end of the year. And if this soft data continue, I think it's going to be a while before the market wakes up and realizes that that's really not good. And we are getting some hints of that when you listen to the earnings statements from companies like Walmart and Target, and not to mention, coming from another industry, Cisco Systems, which, folks, was down 10% today. And that's what I'm talking about. Poor earnings outlooks going forward. This starts happening on an across-the-board basis, and we got something to discuss. The Qs, the hourly chart very much mimics the chart I just showed you on the S&P. The daily chart actually looks a little more suspect to me right here. We do have the same look here on the MACD and the RSI on the S&P, but that does not represent bearish divergence like it does here. So here you have the NASDAQ hitting the July high against long extended bearish divergences, and I do mean bearish when I say this, folks. So this, this would be something, technically speaking, that gets in the way of a bullish end of year narrative. You can see the last time we had bearish divergence was right at the top, right before July, right? We had that going on, and we had these shorter term bearish divergences. This one is longer term and perhaps more meaningful right here. So we'll see how that plays out. Wouldn't surprise me if this fails, but this does look pretty compelling the way we look at things technically. Almost forgot, I did pull up in Nvidia because they announce next week. Now, make no mistake, Nvidia or Nvidia, I'm not sure how to say it, quite frankly, but I'll call it Nvidia for today. This stock right here explains so much, if not everything, about the market move, which is pretty massive from the early March. Now, the market move being in stocks that have been able to hitch themselves to the AI wagon. We know that the S&P equal weight is still probably down on the year, really close to it. So this one is so key to, I think, how the market finishes the year as well. And you can see here, it's stocks like this that'll break your heart if you're a short-term trader. Not that the technicals haven't worked. We had a bear flag pattern, worked virtually to a T. We had a descending triangle there, but we had bullish divergences, so we got a nice pop there. We had a rising wedge right here, and at least on the RSI, we had a bearish divergence. Got a pretty good sell-off in there. You can see we had it there if you want to use the MACD. And then we had, the falling trend here, but we had momentum indicators flattening out, giving us bullish divergences. Here we had a rising wedge, bearish divergences. But these downdrafts here, just very short-lived, and then boom, right? And then we had this longer rising wedge pattern, pretty classic, very notable bearish divergences, and it just blew through it like it was nothing. So anybody who was, shorting, and you really should wait for the breakdown before you do that, got their heart broken right here with this massive gap on earnings right here. But we just kind of came up and just kind of settled in right there, right? So we had some bearish action, in this kind of swing area right in here. Here it is, peeking its head above, right to that August high. And folks, kind of like the Qs, this looks like very bearish to me. If Nvidia disappoints next week, they announce their earnings on the 21st, there is a lot of air under this particular stock, down to 300 like in a heartbeat, right? Easily from there, if it breaks through there, there's just nothing really compelling technically before we get to 200. And so the stock is priced for perfection. Any hint that it ain't what it appears to be or what the market wants it to be, there's just a gaping hole right in here, and I could show you that on my volume analysis maybe next time. So we'll see. I'm not saying anybody should trade this to the short side or the long side, mind you, but this has market implications for sure for, say, the weeks heading into the end of the year if Nvidia disappoints next Wednesday. If they just continue to knock it out of the park, well then, party on for the rest of the year. At least as it relates to this one stock, you can make that case. And then lastly, I think I'll stop here. Yields continues to be, pretty bearish look on the 10-year yield. Certainly nothing in the momentum indicators that says that's ready just yet to bottom. Well, yeah, you could begin to make that case. I'm not as resoundingly bearish as I was up in here. This falling is bullish for stocks between now and the end of the year as well. Folks, just in closing, there's a whole different narrative and a whole different story to be told relative to the setup going into 2024 for equities and other assets too. So this is a time to be very careful and be very, very patient, very, very diversified, and in our case, hedged as well. Thank you as always for watching and listening, and I will talk at you again probably tomorrow. Thanks again. Bye-bye.